Hello, everybody. Welcome to Monday. The S&P 500 was down almost 1.8% today, really in response to a couple of things. Number one is what happened on Friday when we had the jobs report come out. It was better than expected, and wages grew really twice as much as expected, month over month. And so these are things that would put pressure on the inflationary environment, would make the Federal Reserve, raise rates possibly higher than expected, and what have you. And although we are seeing the overall inflationary environment slow down. Some of these things that feed into inflation aren't slowing down, like wages. And so then the next thing that we kind of saw today was that the service economy looks pretty good. Some of the reports that are coming out still kind of hot. Obviously, be better if things were slowing down as far as inflation is concerned. Really, the economy is divided into goods, refrigerators and cars and things we can order on Amazon, and then services, which are, restaurants, movies, travel, those types of things. So we're seeing goods kind of come down and slow down, and manufacturing slowing down and what have you. We're seeing services continue to come up, which makes sense. We've all been stuck, in our homes and such for a long time. And so we're not ordering as many of the goods as we were during the pandemic. And we're actually spending some of that money on, some of the things we can go do now. And we'll see how that goes. That could be a good thing in the sense that there's still some strength in the economy that might make this, potential recession be softer. But it also could mean that the Federal Reserve has to raise rates more and more and more for a longer period of time. And that's a bad thing for the stock market. So we're kind of in this wash area right now. We did break through the 200-day moving average a couple of days ago last week, stayed above there on Friday, fell back below it today. So that's somewhat of a concern. But we did hold our trend line that we've had from the middle of October. We touched it today, so we'll see if we hold that. That could be significant. We did not break through the trend line that is coming down all the way through 2022 here, which would be significant. And really, that's why we only have 75% of our allocation to the stock market portion of our portfolio right now, because we did not break through that trend line. We kind of need to see that and to be able to say, hey, we're actually having a new primary trend to the upside, and we're not just having another fake move to the upside, which this could be so far. So we'll see how this plays out. If we continue to show weakness, we'll probably reduce our exposure to stock market just because we want to see what's going to happen here. We do have the inflation report coming out next week. That could be a catalyst to the upside if it comes in better than expected. So got to probably hang in there for some of that. But really, we're in this scenario now where we're kind of battling it out between parts of the economy that look really good and parts of the economy that are kind of slowing down. Housing, for example, is definitely slowing down. And then, how the Federal Reserve is going to interpret that, and what type of interest rates we're going to have. So look forward to being able to see what's going to happen tomorrow. Talk to you then. Thank you.